Okay, for this session we're going to look at the whole area of residence and ordinarily resident. This is a very important area for the whole area of taxation, particularly in the context of the main taxes, which would be income tax, capital gains tax and capital acquisition tax. That's quite a common question on exam papers. Okay, every student should be aware of the rules with regard to residence. These are basic rules, which is 183 days, which is 6 months in a tax year, or 280 days, which is the aggregate presence in Ireland over 2 years. So if you wanted to be really careful with regarding residence in Ireland, you would be in Ireland for less than 140 days in each year to avoid the aggregate test. There is it used to be called the split year concession, but it's now the split year treatment, and it really only applies to employment income, because let's say somebody leaves Ireland in July, obviously they're here for more than 183 days, and obviously they're resident in Ireland for the year, so therefore they're liable on employment income for the whole year, which will be up to July and after July. Now, if you show to revenue that you're actually leaving Ireland for at least 15 months, and that you leave Ireland for 15 months, what will happen there is revenue will say, well, okay, we'll only assess you on employment income from 1st of January in the tax year to the date you leave, and we won't assess your income, which in this case will be foreign income, from July to the next December. But it applies, as I say, applies only to employment income only. So that's the general rule, is 15 months, employment income only, no assessment on employment income from date of departure to date of return. Whereas people understand residence, the whole question of ordinary residence is sometimes difficult to grasp. The best way to understand it is take it from this little saying here, that it takes 3 years to acquire it, to acquire it, that should be, and 3 years to lose it. So example, he leaves Ireland in June 2012, therefore he's either on if before the end of June, it'd be on the aggregate test, which would be 280 days, or if it's just after the 30th of June, or it would be 183 days, and therefore resident in 2012. Outside Ireland for 2013, 2014, 2015, but those 3 years he still is ordinarily resident in Ireland, and that has consequences which we'll have a look at from the next slides. Then 2016, no longer resident, no longer ordinarily resident, and we'll look at the consequences of that now in a second. Let's have a look at ordinarily resident and CGT. The person who is ordinarily resident for CGT is liable on all gains, Irish and foreign. Foreign gains may, however, be treaty protected. So somebody who leaves Ireland and goes to, let's say, France, or let's say Italy, technically if they make a gain when they're in Italy, they're liable for capital gains tax because they're still ordinarily resident in Ireland. But the Italian treaty will state that gains will only be assessed in its jurisdiction. Carve out allowed for Irish gains, which would be gains from Irish assets. So the ordinarily resident rule with regard to capital gains tax, whereas it's in the domestic law, there is such a thing called a treaty override, which means that the foreign gains will only be assessed in the new country of residence. Ordinary residence and CAT. Now, the general rule with regard to CAT is that gift inheritance is within the charge if the sponer, which is the person making the gift, or the person who's after dying and leaving the will, or the sponee is resident or ordinarily resident. So therefore, there's a double risk here. Either the disponer is resident or the disponee is resident, and it's resident or ordinarily resident. Now, this was going to cause a problem, particularly with what's called non-DOMs, people who are not domiciled in Ireland, and particularly in the whole area of foreign direct investment. Because if you have an executive coming into Ireland to form or to set up a company in Ireland, they'd be resident quite within 6 months, and therefore the whole estate could be subject to Irish capital acquisition tax. Now, if that happens, what the Irish Revenue do, or what the legislation it does, is it allows non-domiciles who are coming into Ireland. It takes them 5 years. They get a 5-year holiday before they start establishing residence or ordinarily residence in Ireland, and that, for a lot of executives coming in to work to Ireland for a few years, it keeps their estate or any gifts they give outside the charge of Irish capital acquisition tax. Otherwise, FDI could have been affected. A person who is not resident nor ordinarily resident, so the previous example there, when he shed the ordinarily resident status, liable on trades carried out in Ireland, that could be from a permanent establishment in Ireland, liable to capital gains tax on the sale of specified assets, which are generally just land and buildings in Ireland. That's why you need a CG50. You'd have to go along to get a CG50, and that's one of the ways revenue control it, through CG50s. Or they're liable on employments carried out in Ireland. Now, that's a very, very important area, liable on employments carried out in Ireland. This is quite a busy slide, but it's a very, very important slide. Let's just get first principles right. There's no mention of it here, but it's very important to bear in mind that anybody in receipt, they could live in any part of the world. If you're in receipt of directors' fees, you're liable to Irish PAYE. And this comes from the famous case of Tipping v Jean Gard, and which means that a director of an Irish company could be living in the Cayman Islands, is still liable on employment on directors' fees paid from an Irish company, in which case PAYE has to be operated. Now, just back to the slide here. The way FDI was set up years ago was that if you got this foreign direct investment, if you got executives coming into Ireland, what used to happen was that they'd be paid from an Isle of Man company. And an Isle of Man company, the individuals would be working in Ireland, and but what would happen is they'd control the amount remitted into Ireland, because the old rules was that you could only be assessed on the amounts remitted into Ireland. And the normal treatment there was that you would set up two accounts, one for where the salary for the work carried out in Ireland goes into, and the other one would be what would be called a capital account, which you could remit to Ireland and it wouldn't be coming from the salary. But that's gone now, so you can really park that. The old remittance planning is gone. If employment is exercised in Ireland, the foreign employer must register to operate PAYE, or if they don't register to operate PAYE, a secondary charge falls on the Irish subsidiary. Subsidiary. Now, if a person, if you just look at that second bullet point there, it's quite broad, because employment exercised in Ireland. What happens if people come into Ireland to do some work on behalf of a foreign employer? Hey, they could come in to could be an accountancy firm coming in to do work on an audit here on an Irish company. So what's the rules with that? Well, what happens then is that if the person lives in a non-treaty state and employed by a foreign employer in that state, and he exercised employment for no more than 30 days in Ireland, but then that's okay. So occasional visits for somebody coming from a non-treaty state. A non-treaty state means a state which Ireland doesn't have a treaty with. So if they come in here and it's not more than 30 days in Ireland, then that's okay. If they exercise for more than 30 days in Ireland, well then what's going to happen then is that the portion of their income earned in Ireland is subject to Irish PAYE. So that has to be controlled. Now, what happens if somebody comes in from a treaty state? Well, then it's put up to 60 days. So if somebody comes in and works in Ireland, let's say they come in, let's say it's a German auditor, and they're sending in employees to audit a German bank, a subsidiary of a German bank here in Ireland. Well then, provided they don't spend more than 60 days in Ireland, obviously we have a treaty with Germany, well then there's no POI exposure on the German firm sending in the auditors. Now occasionally what revenue will allow happen is that if the German auditors coming from a treaty state come into Ireland and they spend more than 60 days, but as long as less than 183 days, obviously with 183 days you'll be establishing residence, well then revenue will allow them not to operate POI. Okay, capital gains tax. I mentioned earlier about capital gains tax with regard to a person who is ordinarily resident. That means they're outside Ireland and they're ordinarily resident. They're in that 3-year period that sometimes you can get what's called a treaty override. Whereas the Irish domestic legislation will allow you to allow the Irish revenue to apply capital gains tax, but the treaty will state no, it's only taxable in the country in which these individuals are resident. Now, what revenue have done in that situation is they've applied what's called an exit tax, and this covers situations where people leave Ireland and they leave Ireland for less than a period of 5 years. Therefore they leave Ireland and they might sell the asset within 3 years if they're in a treaty state and get the treaty override, or in the 4th year when they're outside Ireland, outside the charge under the domestic legislation, they're in a non-treaty state and they sell the asset and then come back to Ireland within the 5-year period. Now if that happens, what happens is that revenue will apply a deemed disposal in the year in which they departed. So a person who leaves Ireland is still within the charge for 3 subsequent tax years of residence. That's the ordinarily resident rule in slide 5. Sometimes this is overruled by a treaty. Even so, if a person leaves Ireland with a relevant asset, he or she can be liable to Irish capital gains tax within a 5-year period. We just have a look at what's a relevant asset, and this is important. If they own 5% of the share capital in a company. Now this is where if somebody leaves Ireland with shares, quoted shares, they're highly unlikely to own more than 5% of the capital in the company. But if it's a private type company, then they probably will own more than 5% of the share capital, and it's a relevant asset if they own 5% or more of the share capital in the company and the value of the shares exceed 500,000. So the charge then is that if you leave Ireland with a relevant asset, you just imagine them going through the airport with the relevant asset, which are the shares. They sell the asset within a 5-year period when abroad. Okay, now if it's a treaty state, they might sell it within the 3-year period. Therefore, they're not worried about the ordinarily resident rule. If it's a non-treaty state, they'd probably sell the asset between the 4th and 5th year. If that happens, and if the individual returns to Ireland within the 5 years, then the individual is deemed to sell the asset at market value on the last day of his or her departure. So it's a deemed disposal. So example, Anne is offered 30 million for 100% shareholding in Digit Limited. She leaves Ireland in 2010, resident look back test, or if she left in July, you'd be resident under the 6-month test, 183 days. She moves to the Cayman Islands. Now the Cayman Islands, we've no treaty with the Cayman Island. She sells the shares in 2014 after the 3 years of ordinary residence has expired. She had to worry about the ordinary residence rule because no treaty, that means no treaty override. And she returns to Ireland in May 2015. She is liable on the 30 million in 2010. So the last day she left Ireland, the last day of that tax year, she's as if she sold the shares when she was leaving and at the market value, and is liable to capital gains tax. Now if she was to wait for another year, she'd be outside the charge to tax. So they're the key rules on residence and ordinary residence. Be very careful with the whole area of this relevant asset exit charge. That's very important. And be very careful with the whole question of employment income, when an employment income is liable. Be careful also with the whole question of that even if you're non-resident, if you sell an asset, you could be liable for capital gains tax if it's what's called a specified asset here, which is land and buildings in Ireland. Be careful that if you are resident or ordinarily resident in Ireland, your whole estate, and the estate could be if you die, or any gifts you make could be liable to Irish capital acquisition tax. Now, bear in mind that would apply, it's either the disponer or the disponee, if they're resident or ordinarily resident. Therefore, they're liable for capital gains tax on the disposal of an asset. And bear in mind, capital gains tax on the disposal of an asset, if there is CGT due, there could be a corresponding CAT credit if the asset is held for 2 years. Some people make a big mistake of actually selling an asset, getting the cash and handing the cash over. Obviously that doesn't apply. And bear in mind also that there could be questions of retirement relief if the person's the right age. There could be a question of agricultural relief if they meet the the farmer test of 80%. So that's just a brief whistle-stop tour of residents and ordinary residents.